Hey everyone, Greg here presenting solo as Mark is at the cottage. You might notice something different about our opening screen for our monthly update, and that is the new logo. It's been 4 years since I joined Mark, and so while Mark will be here for another year or two, I felt it was time to rebrand. And with our new brand comes our appeal to new and younger clients. What I wanted to do today was give you a quick update on performance and then take you through the new onboarding presentation I show to new clients. In essence, it's a presentation that explains how I've built your existing portfolio and what differentiates our portfolio management to other local financial advisors and financial planners. So let's get started. First, with our market update, the orange guy down south is at it again, but the markets aren't buying it. This time he's decided to up tariffs on Canada to 35% and set a base European and Asian tariff somewhere between 10 to 15%. But how have markets reacted? Well, they certainly don't believe Trump because he keeps kicking the can down the road, changing the dates. They think at the moment we start to see, sorry, they think the moment we start to see issues with the US economy, that Trump is going to backtrack. That's the reason why markets, which are always forward looking 6 months to a year, have rebounded so strongly over the past 4 months since our April lows. Stocks have rebounded, depending on the markets you're looking at, 10 to 20%. Hence the picture, Taco Trump. Trump always chickens out. Now, I want everyone to brace themselves for some volatility because we are coming up to the deadlines that Trump put on himself. Over the next month or 2 or 3 months, we could see some big swings in the market. I don't think it's going to be what we saw in March or April, but I do want people to brace themselves. I think we're also going to see quite a bit of bad economic data start to work its way through both corporate profits and the US and global economies. And if Trump doesn't lower tariffs as the markets expect and chicken out, we could see a recession hit. Of course, there's no way for us to know. So we just buckle up for now and we stay the course. Anyone who's been on the sidelines for the past few months has missed out on the amazing rebound. Now, on to our or your investment approach. I'd like to kick things off with this slide showing an ox and a hanging hook scale. Over 100 years ago, back in 1906, at the Plymouth County Fair, Sir Francis Galton, Plymouth County being in England, a British statistician launched an experiment where around 100 attendees were asked to guess the weight of a slaughtered ox at a county fair. Those participating consisted primarily of farmers, but some weren't farmers. Now, if you were to guess, how closely on average do you think participants were to guessing the ox's weight? Do you think they were within, say, 30 pounds of getting it right, within 50 pounds, or within 100 pounds? I'll give you a moment to think of a number. The answer is they were very close. In total, there were 787 submissions, and the combined average of all 787 guesses was within 1% of the ox's true weight. This phenomenon, it's known as the wisdom of crowds. That is, it follows, and I'm going to read this. In general, a crowd's judgment can be modeled as a probability distribution of responses, and the median of all responses finds itself near the true value of the quantity being estimated. So what does that have to do with investing? Well, it's that stocks and bonds follow a similar principle. The value of a stock, for example, let me take an example here. Bell Canada currently trading at $32. That $32 price reflects the wisdom of hundreds of millions of investors. It means that the current price of a stock for any publicly traded company always represents its fair value. It's neither undervalued or overvalued. It reflects all publicly available information, and the price it currently trades at is its correct value. And so why is this important to you? It's because your investment portfolio does not consist of any managers that are trying to pick or guess what stocks are going to beat the market. And that's because those expensive portfolio managers, they can't do it. People who pick and choose stocks can't act quickly enough on this information, nor can they consistently beat the wisdom of the crowd. Here's the latest Canadian fund manager scorecard from SPIBA S&P Global that shows the amount of active Canadian fund managers underperforming their benchmark after fees. And guess what? You own that benchmark. That is your portfolio. You are outperforming active managers with my approach. The Templeton and the DFA funds in your account are very low fee benchmark portfolios that consist of index funds and like an index strategy. If you look at the far right of this bar chart slide, the majority of good advisors and yourself, you're in a global portfolio. Good advisors have their clients invested globally. But if they use active managers or active strategies, there's over a 95% chance, it's closer to like 96, 97% chance that those active managers that are in their portfolio, they're going to underperform the index or the benchmark. So that means that unless they pick one of those 5% managers, they're going to underperform what I'm doing for you. But Greg, you might be saying to yourself, why don't you just build a portfolio to beat the market using those 5% managers? The answer? It's impossible to know who those managers are. On this slide, Dimensional Fund Advisors, DFA, which is a product you likely own in your portfolio, looked at the entire US equity mutual fund landscape. Basically, US stock picking fund managers, so the best of the best stock pickers in the world, they then chunked out a series of 5-year periods to look at the consistency of these stock pickers, of these top performing managers, the expensive ones. And their findings, if you're a top 25% manager, and I, as a financial planner or financial advisor, decide to include you in my clients or your portfolio because of your amazing performance, that the following 5 years, there's only about a 25% chance on average, you'll still be a top manager. So what does that mean? It means that people add these hot managers in Canada and the United States after they've already performed. And then the performance falls off because the manager is no longer lucky. In summary, DFA, Dimensional Fund Advisors findings, and the conclusions they come up with, I 100% agree with. And that is outperforming funds, they're in the minority. We saw it 2 slides ago that only about 5, maybe even less, 5% of all active managers are outperforming the benchmark. The slide after that, the previous slide, we saw that strong track records failed to persist. That means that if you're a top manager, that the likelihood of you remaining a top manager is less than 25% for the following 5 years. And also that high costs and excessive turnover. So if the manager is trying to move between holdings, move between stocks, and is getting in and out of positions, it's likely going to contribute to underperformance. What's the lesson to be learned from this? Well, the lesson is one that I've basically taken and formed into a portfolio for you. And it's that markets are effectively aggregating all investor knowledge and expectations into their prices reliably. That's what we see with the wisdom of the crowds. And any managers attempting to outguess market prices, they may incur high costs, and the likelihood of them beating the benchmark is very, very low. Most successful investing, getting you good performance, involves more than picking a top performing fund. And it's actually quite simple. It's just picking an index portfolio, keeping costs and turnover low, and focusing on financial planning. In summary, again, how is your portfolio built? Well, we use only index funds or index strategies to deliver returns. We know it's impossible to beat the market. Well, or it's very unlikely we're going to beat the market. So when we buy the index, we buy you that market. That means that we outperform 90 to 95% of those active managers we saw on the previous slide. You're also likely to outperform the other local financial advisors or financial planners who are buying active strategies for their clients. And we also don't make big changes or shift between being invested and going to cash. That is a losing proposition. We're going to get that timing wrong. The best thing to do, and what we do for clients, is we buy and hold indefinitely using these low fee index products. And that's basically it. That is how I deliver strong returns for you and how I'm going to continue to deliver strong returns for you in the future. So with that refresher, thank you for tuning in and listening to our update. I hope you found some value. I look forward to delivering our next monthly update at the end of August, heading into September. Thank you so much.